Yes. All right. So Jedi Options for today, we're going to talk about implied volatility rank, which is an indicator. We use IVR as the abbreviation. To set the stage for this, I want to back up a step and refresh our memory on how option contracts are priced. So decades ago, Fisher Black, Myron Scholes, Robert Merton, they created this formula called the Black-Scholes model, which is how derivatives like options are priced. And there are 6 inputs to that model, six variables you have to know or put into the model to spit out a price. Okay, it's a pricing model, gives you an idea of what a fair price is for an option. So the first thing is the stock price. Got to know what the stock price is. If it's a $100 stock, the option is going to be priced differently than if it's a $10 stock. You got to know what strike price you're pricing here. Is this an at the money option, in the money, out of the money? That's going to impact how much it costs. Time, is this a 30-day option? Is this a 1-year option? That's going to influence how much we pay. Does the company pay dividends? Remember, when a company pays dividends, the stock price drops by the amount of the dividend. It gets priced out. If it's a high dividend paying stock that every quarter is going to drop 1%, probably need to know that when we're pricing an option. Because if that option expires in a year, the price of the stock should be lowered by the amount of the dividend, how many dividends get paid over that year. You got to adjust for that. Remember, these guys are smart, okay? They take into account every variable that matters to the stock and thus should matter to the option. How about the cost of capital? Interest rates have an impact here as well. When you buy an option, you don't have to pay as much money. So you're freeing up a bunch of capital that could then go earn risk-free interest. When interest rates are high, that has an interesting impact in terms of the appeal of using an option versus tying up money in the stock. So far, all 5 inputs are known variables. It's not up to debate. Stock price is what it is. The strike price is what it is. Both parties would agree in terms of these numbers, okay? But what about supply and demand? Like any freely traded good, to a certain extent, there should be a supply and demand component, right? This is a freely traded market. People can buy call options. They can sell call options. They can buy puts and they can sell puts. And so where does the whole supply and demand component come into play here? Because this model would have to take that into account somehow. And the way it does that is it looks at volatility. And when you price an option, you just kind of put in a forecast in terms of how volatile you think the stock's going to be. But the reality is you don't know. Nobody knows the future. If you're pricing a 1-month option, you don't know how volatile the stock's going to be over the next month. You can use history as a pretty good guide, and it is a pretty good guide, but you don't really know. So you put in a volatility forecast, and then it spits out an option value. It says, okay, based on everything you just told me, this option should be worth $5. And then the option starts trading. It starts trading. And if you assume all those variables stay the same, the stock price doesn't change, the strike price doesn't change, time doesn't pass, dividends, interest rates don't change. But then you get a bunch of demand for the option. Everybody starts buying this option up. Well, all else equal, the option value is going to go up. And if the fair option value is $5 and the option value goes up to $6 or $7 in the marketplace, right? So the marketplace actual value of the option is $7. The only way that's a fair price, paying $7 for an option that initially really was $5 as a fair value. The only way that's a fair price is if the stock's going to be more volatile than originally anticipated. So that expensive $7 price implies the stock will be more volatile moving forward. In fact, the stock would have to be more volatile moving forward for this to be a fair price. So implied volatility is essentially how volatile the stock would have to be for options that you're buying right now to be fair, to be accurately priced. So what's interesting is implied volatility is the variable that's sensitive to supply and demand. It's the number you can track to get a sense of how much supply or demand there is for the option, which in turn tells you if the options are cheap or expensive, right? So ultimately, implied volatility is that variable we use to give us some clues as to whether people are bonkers right now and they're paying a lot for options, or whether there's just no demand and options are super cheap. And knowing if a good is cheap or expensive makes you a more informed consumer, and it makes you a more informed trader, because as a trader, you could be both the buyer, the consumer of that good, or you could be the seller of the good. You could be the business that's selling this piece. And if I could be different on different sides of this at different times, I could maybe position myself to buy when the good is cheap and to sell when the good is rich or expensive. That would come in handy. And that's why option traders focus on implied volatility so they can make a more informed decision. Okay, so that's the first piece, right? Implied volatility measures whether options are cheap or expensive. Okay, so when you plot this, pardon the typo there, we're going to draw a little picture here. So implied volatility is different for every stock, and so let me go here. Actually, we're going to have a little black background. It's going to make this a little easier. So the implied volatility of something crazy like Tesla is going to be different than the implied volatility for Walmart. And the IV rank is going to help us to equalize those, so it's a more apples to apples comparison. So let's say we're looking at a more volatile stock like Tesla, and its implied volatility is plotted as a line over time. Okay, and then you have a more boring stock like Walmart, and it's going to have an implied volatility that fluctuates over time. And what you'll discover is that the scale is different for each one. So for Tesla's implied volatility might be as high as 150% and as low as 75%. Walmart never trades with 150% implied volatility. It's much more tame. So maybe the high for Walmart is 30%. And the low is maybe 10%. If it ever
does, something really, really strange happened in the world.
Yeah, can't imagine something insane would have had to have happened. Yes. Yes. I could talk about that for a while, but yeah, 100%. So the problem is, if you just at face value say, oh, right now Tesla has a volatility of 76%, and you look at that like as a column in a watch list, say, oh, Tesla's IV is 76%. And Walmart's IV is 29%. 29%. Well, like, what does that tell you? I mean, that tells you that in general, Walmart options are lower than Tesla options, but they probably should be because Walmart's tame. Is 29 comparable to 76? Well, no, because these aren't in the same range. The scale is different for each implied volatility number. And so how do I equalize that so I can actually compare Tesla options to Walmart options without it being weird? You have to equalize the range. You have to set whatever the lower number is to 0 in both of these. And you set the upper number, whatever it is, to 100. Now I've equalized the scale. Now what I can do is I can state the current volatility as a percentage of the scale or a percentage of the range. So Walmart is trading at the upper end of its range. So the IV rank or the IV percentile for Walmart, remember, the first one was the actual IV. Now we're ranking this as a percentage of its range. It's at like the 99th percentile. It's at the upper end of its range, right? And Tesla 76 is really close to the low end of the range. So its IV rank is like, I don't know, let's say the 2nd percentile. Now, what's fascinating is now I can compare these. These are stated in like terms. Originally, it looked like Walmart had cheap options and Tesla had expensive options, but that wasn't apples to apples. When we analyze implied volatility, is it low, is it high? the way you do it is you compare the stock versus, you compare the current reading versus the range. And so when you look at the range on Tesla, there's the upper end, there's the lower end. Right now, it's near the lower end. When you do the same thing on Walmart, there's the upper end, there's the lower end. It's at the upper end of the range. I didn't really know that when I just said Tesla 76, Walmart 29. I didn't know 29 was the upper end of Walmart's range and 76 was the lower end of Tesla's range. I didn't know that without looking at the actual chart and doing the numbers. But the IV rank does it for you. It equalizes it for you. I know the 99th percentile is the upper end of the range for Walmart. That tells me Walmart options are expensive right now. I know the second percentile is the lower end of the range for Tesla. Tesla options are actually cheap at 76%. Okay, so here's the key takeaway. You might have to watch this a couple of times because I went quick. The key takeaway is IV rank equalizes the implied volatility. Okay, that's one key takeaway. As a result, it allows you to compare the options of different stocks that have completely different volatilities and know right now, is Tesla trading with cheaper options? Is it trading with more expensive options, particularly relative to something else like Walmart? For me, I would rather sell options on Walmart in this case and buy options on Tesla. I would rather sell options on Walmart because they're expensive, and I'd rather buy options on Tesla because they're cheap. And that's something I can quickly discern by using that IV rank number. So in Thinkorswim, final point here, it is possible to add implied volatility rank as a column heading and quickly see who's trading at the lower end of their range, meaning who has cheap options, and who has options that are trading at the upper end of their range. So like EWW, you can sell options on EWW if you want. They're not going to pay you much though. Get the IV rank up here. They're not going to pay you much. So options on this Mexico ETF are cheap, and options on the biotech ETF are expensive, 66th percentile. So I can get a quick sense of who has cheap options, who has expensive options by using that IV rank metric.